in today's world, we have more or less two types of networks. The proof-of-work networks, for example, Bitcoin, and the proof-of-stake networks. For example, in the latest upgrade, Ethereum, which originally was a proof-of-work network, has become a proof-of-stake network. What does it mean? In the proof-of-work networks, miners need to basically buy computational power to mine Bitcoins, and so earn the rewards when they win the computational power race, solving the puzzles. In the proof-of-stake networks, you need to basically buy the original asset, the native asset of the network, and put it at stake, basically putting your capital at stake to earn the rewards of the network that are generated by the fees, in turn generated by the network. Now, Bitcoin in today's world is a proof-of-work network, so it cannot be staked. However, there are new technological solutions that allow Bitcoins to be staked to other networks or even restaked to additional services to basically power these other networks and secure them. So the yield for Bitcoin staking doesn't come from the Bitcoin network, which is still a proof-of-work network. And it comes from other networks which might be powered and secured by the Bitcoin with a stake.
Why is there an appetite for this? And how big is it now? How big is it going to get? Why is this so important for this ecosystem?
Well, let's put it this way. So first of all, proof-of-work networks are kind of a little bit older technology than proof-of-stake networks, which are more, I would say, capital efficient. But in spite of this, in the case of Bitcoin, is really having an asset which is the most liquid asset, the most traded asset, basically the proof of the kind of the research store of value type of asset, which until today didn't really have a lot of utility in the network itself. So it was a store of value asset, and it was not productive. With these kind of recent developments, you can transform a kind of idle asset into a productive asset. Yes, you will have to accept additional risks. So yield doesn't come for free, obviously. Risk comes.
Risk then? Like,
the risk is that, for example, if I want to secure another network using my Bitcoins, then those Bitcoins will be exposed to certain risks that happen on those networks.
Can they take away my Bitcoin?
They could take away your Bitcoins in case certain things happen in these networks in exactly the same way as it happens today in the Ethereum network. If one of the validators double signs a transaction, your ETH could be, or double spent, for example, double spends your ETH could be slashed or basically taken away. In the same way, your Bitcoins that are very safe in the Bitcoin network, if you put them at risk to secure another network, if there is an issue in this other network, you might lose part or all of the Bitcoins that you're putting at stake.